That what?
The cost of capital used to discount
Yeah,
the
it's what?
finance side effects is I think we use cost of debt. Yeah.
That's not an assumption. Let me deal with this guy. Give me 1 minute. Oh, yeah, go down. Go inside. One, two. Go inside. Oh, yeah, go inside. Go inside. Go inside. Go and meet your mom. Go inside. Go and take water from your mom. I don't have water here. Yeah. Sorry, guy. So that's not an assumption. That cost of that is not an assumption. Now, I told you that the first assumption you should make when you compute, when you solve a question that involves cash flow is what? Always assume that
The cash flow.
that's the first thing I expected that you will give me. That we assume that it is assumed that the cash flows used are accurate. That's one. Number two, we used inflation for this question. We use 8% for revenue for 4 years. We use 4% for cost for 4 years. So it is unlikely that inflation will remain at 4% and 8% in the next 4 years. So it's an assumption. So we have assumed, it is assumed that the inflation rate of revenue and direct cost will remain
There was inflation for fixed costs too.
8%.
Okay.
Do you have inflation for fixed cost?
Okay, no.
There's no fixed cost.
No,
There's no
no
fixed cost in the solution.
this question. Yeah. Is the other one?
Yes. So it is assuming that the inflation rate of revenue and direct cost will remain at 8% and 4% respectively for the next 4 years. That's an assumption. That's an assumption. Assumptions are not difficult to pick up. These are where you can get your cheap mark and you boost your chance of passing the exam. Assumption. So assumption number 3, I'm assuming that it is assumed that the business risk of Denko Limited will be approximately the same. With the business risk of the project being considered by Franco Limited. This is another valid assumption. Okay, it's another valid assumption. Now, when we are on journey the better of Denko, did we use a better of debt? No. Why? Because better of debt was not given in the question. So we are assuming that our debt is risk-free
Zero.
with a beta of 0 because the question did not give me beta. So I am assuming that beta of debt is 0. So it is assumed that debt is risk-free. Debt is risk-free with a beta of 0. With a beta of 0.
So can you explain this assumption number 3?
Number 3, Abby. Now, you know when the beta of assets we computed was for the industry where Denko is Abby. Hello?
Yes, sir.
Beta of asset measures what?
Business risk.
Now, we enjoy the beta of Denko in order to get business risk. What business risk did we get? The business risk of the industry where Denko is operating. And that is the industry where Franco want to undertake that investment. So we are assuming that the business risk that Denko is facing in that industry is the same business risk that Franco will face if it decides to invest in that particular industry. Do you understand? Hello?
Come again, sir, please.
Shebi, this, the one we computed is for who? Denko industry.
Yes.
Now, Franco want to come into that same industry. Franco want to come into this same industry here, where Denko is. This, So we are assuming that where Denko is coming, by the time Denko come and invest in this industry, the business is still going to be the same. Meaning that whatever business Denko is facing, whatever business Denko is facing, is the same thing Denko will face if it comes to that industry. Do you understand now?
Yes, sir, I understand.
So these are the four relevant assumptions. You can get more anyway. And these are the 4 you can quickly pick from this question. Each of these assumptions can give you one mark or at least half a mark. So if you state 4 assumptions, now this is the logic. If a question asks you state 3 assumptions, one assumption is 1 mark. One assumption is 1 mark. So see that they put 3 marks there. So it means one assumption will give you 1 mark. If you state 3 assumptions, you get 3 marks. But if the question says state 3 assumptions and they put 3 marks, and because you know many assumptions, you now state 5, you are still getting 3 marks. Okay? You are still getting the 3 marks. And if some of the 5 you stated are wrong, the wrong one will be applied and the right one will be cancelled. Yes, now. That's how it is marked though. So that's why you don't need to do more than the requirement of the question. If you do, it's going to be a serious problem. Your right answer will be cancelled, the wrong one will be applied. So let's go to the requirement B. Requirement B, comment on the corrections made to the original net present value estimate and explain Apv approach taken in part A. Now, 2 in 1. We want to comment on the correction made, and we explain the Apv approach that we have taken to solve this question. So B, 1, comment on correction of errors. For the purpose of debt were made. The following options were made to the original NPV computation. Okay, sorry, my network went off. I said the following corrections were made to the original NPV computation. So let us highlight them. One, since the inflation rate this is as the inflation rate of direct cost. The cash flows have been inflated, contrary to the original treatment in the initial NPV computation. So you have explained that. Two, figure 2, interest payment has been ignored. We ignore it as been ignored as this is not an investment cash flows. So that in investment cash flows, but a financing cash flows. Okay, so financing cash flow. That's the reason why we did not consider it. And even though it is a financing cash flow, it should have been considered under WACC. That's second correction. Number 3, the working capital was considered as a result as a result of time value of money. Time value of money. Even though working capital will be recovered when the project ends. It will not have the same value at the end of the project with the value at the beginning of the project or any other years. That matter. So you have also explained that. You can see that there's nothing difficult here. Honestly, there's nothing difficult. It's what we did that I'm just explaining here. Why did you include this? Why did you exclude it? Okay, I excluded it because of this. I included this because of this. That's all. Which other thing did we do? Did you correct any other thing? Can you remember any other thing that we corrected? I think these are the corrections we made. These are the three major corrections made. I don't think we have any other corrections. Now, APV approach. I'm not going to give you this because we have already discussed this. APV approach. Is there anybody who cannot explain the APV approach? I don't think so. What do you need to tell them? Don't say that if Franco undertakes this project, the existing business risk, the existing business risk of the company will change because the project is in an entirely different industry. Also, financial risk of Franco Limited will change as a result of the mode of financing the project, that is debt in this case. For these reasons, the adjusted present value approach is more appropriate. To evaluate the project. The APV has been computed by discounting investment cash flow. By discounting investment cash flow because investment cash flows using cost of equity on jet obtained from the better of equity of Denko on the assumption that business risk of investment in industry will be approximately the same as the business risk of the industry. This resulted in base case MPV. So I've explained base case MPV. I've explained, you can see the reason how did I start? I started by letting the examiner know the reason why I have used APV. I explained the condition for using APV. And now let the examiner know that this question met the conditions that will warrant me using APV. So I have used APV. Now, how did I compute that APV? And I asked, okay, APV was computed by using what? By discounting investment cash flow using cost of equity on GED. And how did I get my cost of equity on GED? By on gearing the better of equity of Denko on the assumption that the two businesses will have the same business risk after the investment. It's not story at all. Just short, and you move. Now, I will go further and now discuss how I have gotten my PV of finance effect cash flow. Okay. The cash flows, the reason why I'm like, I first said that I was not going to give you, but I have to give you because I don't want any form of excuse. If this question should come out to the exam and I didn't give you this part, because it did not give us this part, that is, I want to vindicate myself. And I told you this examination likely question, even though APV was set 2 days ago, okay, even though it was set 2 days ago, it does not mean that it cannot be set again, only that the probability is a bit low because it has been recently tested. Okay, it has been, even though if this question is not set this date, in the next couple of dates, you see this question in the ICANN examination. So the cash flows associated with financing the project, such as issue cost, tax saved on issue cost, tax saved on interest, tax saved on interest, and net savings. Net savings on subsidized loan, were discounted using cost of debt to get the present value of finance effect cash flows. The addition of the base case NPV and PV of finance effect cash flow gave the APV of 10.19 million. Full stop. That's all. That's the APV approach taking. So I've answered the two requirements. I've commented on the corrections made. I've commented on the corrections made, and I've explained the APV approach taking. That's all. Are we fine with this? Are we fine? Any question on this, please? Any question? Any question? Oh, where's my charger? Question, please. No question, right? Okay, if there is no question, let's go to the next question. Let me just plug my charger. My phone is about to go off. Where's my charger? 1 minute, please. Okay. So any question, please? Any question? No question, okay. So let's go to the next question on APV. After this question, we are going to international investment appraiser. International investment appraiser. Okay.
Sir.
So let's look at this. Yeah.
What about merger and acquisition? Is it not part of the syllabus?
Merger or acquisition. When we have not done business valuation. We have to do business valuation before we have not got into merger and acquisition at all now. After this, we are going to business valuation before merger and acquisition. And of course, how will merger and acquisition not be part of the syllabus? That's the core area of the syllabus now. These are potential 30-mark questions.
Yeah, I've been expecting you to touch it. All this.
It's topic by topic now. I said it at the beginning of the first day of the class when I gave you the syllabus breakdown. You understand? I told you how we are going to operate. That cost of capital, business valuation, the merger and acquisition. Cost of capital, investment appraiser, business valuation, merger and acquisition. 4. After taking those 4, we now come back to option pricing theory, what do you call it? Bond valuation, portfolio theory, and CAPEX. You understand? If you cover all this, you won't have any issue. Don't worry. We are getting there. That's no the only thing. My only prayer is that you get time to study. Okay, that's my prayer. So let's go to requirements of this question. Required: A, estimate the adjusted present value APV of the proposed investment. B, comment upon the circumstance under which APV might be a better method. I'm not going to give you this. You'll be the one to give me the answer. If you cannot give, I will not give you. Okay, before we even go there, oh yeah, can you answer this question? This part here, that part B. Comment upon the circumstances under which APV might be a better method of evaluating a capital investment than net present value. Can you give me the solution to that?
If there is going to be additional finance
One.
for the project.
One.
If there is issue cost.
Mrs. Shui. Mrs. Angela. Can you give me one each?
Now what?
What I highlighted there?
Comment upon the circumstance under which APV might be a better method of evaluating a capital investment.
Yes.
When there is an issue, definitely you use APV. Though I did not hear what she answered. I say when there's an issue cost, definitely it's APV.
Okay, when there is issue cost, okay. What other one?
When there is subsidy.
Interest.
No, I gave you about 4 or 5. Business risk changing, financial risk changing, issue cost, complicated tax payment, subsidized loan. Please understand all this. These are the situations. And I now explain that the major one is where the financial risk will change. Okay, I said that is the major one where financial risk will change. Other ones are if financial risk is not changing, you cannot have subsidized loan. You cannot have issue cost. Do you understand? So issue cost, subsidized loan are coming as a sort of what? Taking new finance. So if you have to explain, to comment upon the circumstances under which APV might be a better alternative, is actually a bonus question for you. Issue cost, business will change, financial risk will change, complicated tax payment, and what? And when there's going to be a subsidized loan. So I'll give you 5 again now. So I'm not going to touch that B part again. So this is the A part we're going to deal with. Let's see the question. The managers of Australia Incorporation are investigating a potential 25 million investment. The investment will be a diversification away from existing mainstream activities and into the printing industry. So you can see diversification. Diversification is what brings a change in business risk. When you are diversifying, is where your business risk is changing. If you are not diversifying, your business risk will not change. So the moment you see diversification, then obviously business risk is changing. 6 million of the investment will be financed by internal funds, 10 million by rights issue, and 9 million by long-term debt. The investment is able to generate pre-tax net cash flows of approximately 5 million per year for a period of 10 years. Okay. The residual value at the end of the year 10 is forecast to be 5 million after tax. As the investment is in an area that the government wishes to develop, a subsidized loan of 4 million out of the 9 million is available. This will cost 2% below the company's normal cost of long-term debt finance, which is 8%. Strayer's equity beta is 0.85, and its financial gearing is 60% equity, 40% debt by market value. The average equity beta in the printing industry is 1.2. An average gearing 50% equity, 50% debt by market value. The risk-free rate is 5.5% per annum, and the market return 12% per annum. Issue costs are estimated to be 1% for debt finance, excluding the subsidized loan, and 4% for equity financing. These costs are not tax liable. These costs are not tax liable. The corporate tax rate is 30%. So compute the adjusted percent value. This is an easy decision to make. Obviously, this project is going for 10 years. ICA will not give you a spreadsheet that will enable you to open year 1 to 10. So the way we are seeing a large number of years, it is an indicator that you are going to use annuity. Please, can you give me 1 minute? 1 minute, please. Okay, sorry for the break. I just need to attend to an issue. So let us continue. So Example 29, okay. Don't turn it back. So we have what's the name? Straya. Straya incorporation. Okay, we want to compute adjusted present value. Computation of APV. Now we have year. I have my year 0. I have year 1 to 10. I won't open year 1, 2, 3 up to 10. I just have year 1 to 10. Then I will have year 10 for my scar value. That's all. That's what I will do here. Okay. 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 Let me use a table. Let me use it so that it be that our work can be easy. Okay. So year 0, 1 to 10, year 10. Okay. So I have my cash flow. Cash flow, DCF, at whatever percentage. Then I have my present value. I'm going to copy this from here. That's not where I want it to sit. To sit here instead. Yeah. Okay. So in year 0, I have my investment. That is my outlay to be in year 0. When you have project that is going for several number of years, that's the way you treat it, because you cannot open year 1, 2, 3, 4 up to year 10. It is not possible. It is not possible. So let's go. What's our outlay? We're told that a potential 25 million investment. The investment will be diversification of, okay, blah, blah. 6 million of the investment will be financed by internal. Okay, so we're talking about 25 million here. Let me see. 10 million by right issue, 9 million by long-term loan. The investment is ready to generate if it has blah, blah. Forecast to be 5 million. Consider value out of the total 9 million. Okay, so the outflow is 25 million. I come here, outlay 25 million. Let me work in thousands. So I have 25,000. Now, we have our inflow. Our inflows. We're told that our inflows is pre-tax. Let's go and see that. Our inflow is pre-tax. Pre-tax of how much? Pre-tax of I'm trying to pick the figures. The figure I need. Okay.
5 million.
5 million for 10 years. 5 million for 10 is pre-tax. So the moment it is pre-tax, just go and adjust it for tax. 5 into bracket. What is our tax rate? The tax rate is 30%. So adjust it for that rate because we are going to pay tax on it. We are going to pay tax on it. So you take the net. So that's going to give us, I think 3.5, if I'm not mistaken. 3.50. 3.5. Okay, million, Abby. That should be 3,500. 3,500,000. 3,500,000. Then at the end of the year 10, we're going to have scrap value. You can see that this question is simple. Scrap value. The scrap value is going to be, what's the value for the scrap value?
$5 million. The residual
Okay.
value of
5 million. After tax, Abby? If it is before tax, you have to charge tax or you compute balancing adjustments. Here we are not having anything like a balancing adjustment because the question has told us the net investment we are getting from this project. So I can remove all these ones. I can remove all this one from here. Now, we need cost of capital. And the cost of capital we need is what? Is on gear cost of equity. So we need to go and compute our on gear cost of equity. Cost of equity on geared. Now, the company is going into printing industry. We are given the beta of the industry. What is the beta? Beta of equity. Beta of equity of the industry. Beta of equity of the industry is given as what? Beta of equity of the industry is given as, where do I have that? Average equity beta in the printing is 1.2. Gearing is 50-50. Okay, good. So 1.2. We need to ungear this. The beta of equity using the beta of equity using the industry gearing. Using the industry gearing. So to ungear, we have what? Beta of asset is equal to beta of equity times market value of equity all over market value of equity plus market value of debt, 1 minus tax. 1 minus tax. So market value of equity is 50. Market value of debt is also 50%. Tax rate is 30%. 30%. So rate of assets is equal to 1.2 times 50 over 50 plus 50, 1 minus 0.3. So let's get it. Beta of assets is equal to 1.2 times 50 is what? That should be 55, right?
60.
60, okay. 60 over, so 50 times 0.3, 0.7 rather. So this would be 85, if I'm not mistaken.
Yes, sir.
Okay, 85. So let's divide what we have there as our beta.
0.7.
0.7. Okay, that's our beta of assets. So you don't reject because we are doing what? APV. Just put it in the CAPEX formula. Cost of equity on GED is equal to risk-free rate plus beta of assets market return minus risk-free. So cost of equity on GED is equal to, what's our risk-free rate? Our risk-free rate in the question is given as what do you have our risk-free rate? Okay. This is equal to 2% below the. The risk-free rate is 5.5%. Our market return is 12%. 5.5%. 5.5% plus 0.7 open bracket 12% minus 5.5%. Cost of equity on GED is equal to 5.5%. 5.5% plus 0.7 to bracket. This will be what? 6.5. So what's the cost of equity on GED? Give me the figure. What do we have?
10.1.
10.1. So we are using 10% or 10%. We're using 10%. So go straight to that place. I have my discount factor at 10%. Year 0 is 1.000. Year 1 to 10 annuity factor will be what?
6.145.
6.145 times 3,500 is what?
21,508.
21,508. 21,508. Now, 10% year 10 will give us what?
0.386.
0.386, Abby,
Yes, sir.
times 5,000.
1,930.
1,930. Now here, to provide the gas to the examiner, I can just put all figures in thousands. All figures in thousands, so that they know that you are working in thousands. So what is our NPV? Sorry, base case NPV. base case NPV will be what?
-1562.
1,562.
Yeah.
Okay, that's our base case NPV. Now, we now have to go and sort our PV of finance effect cash flow. So, finance effect cash flow. Finance effect cash flows. Number one is what? Gross finance. Don't forget, I've given you the framework. If you follow that framework, you can never go astray. Gross finance required. That is the starting point. Gross finance required. Now, we're told that, let's go back to the question, 25 million, 10 million by right issue, right? 10 million by right issue, 9 million by long-term loan, 6 million will be financed by internal fund. The one that will be financed with internal fund there, okay, no problem, I will include it. But see that it will not have any impact at all. It will not have, because you are not, that one is not additional finance. So let me say internal is 6 million. Subsidized loan. Subsidized loan is what? Out of the 9 million, 4 million is subsidized. So I take the 4 million subsidized loan. $4 million subsidized loan. Okay. After the 4 million subsidized loan, what do we have? We have normal loan, which is going to be 5 million. Normal loan.
So what did you say the 4 million subsidized loan?
I'm coming. Normal loan, 5 million. Right issue. Right issue is 10 million. Okay. Now look at it. The investment is here to generate. Okay, let me start from the beginning. Let me start from the beginning so that you see from where I picked that figure. $6 million of the investment will be financed by internal fund, having 10 million by right issue, and 9 million by long-term loan. Now the question now came here. When I came down, as the investment is in the area that the government wishes to develop, a subsidized loan of 4 million out of the 9 million. Out of this 9 million, 4 million of it is what? Subsidized. Meaning that the 5 million is what? Is normal. Did you understand now?
Yes, sir.
Okay. So if you add all this together, we're going to have our 25 million finance requirements. Total 25 million. $25 million. Good. We have gotten our total finance requirements. What's the next thing? Issue cost. That's 2. You can see that anytime I'm solving APV for you, this is the format I always follow. There's no two way about it. Once you follow this format, there won't be any problem. So issue cost, let me sort it. Issue cost. Let's see the information on issue cost. Okay. Issue costs are estimated to be 1% for debt financing, but that 1%, that debt financing is excluding subsidized loan. So it means issue cost on debt is 1% of normal loan and 4% for equity financing. Now, these costs are not tax allowable. Take note. So, issue costs, I will have debt. Issue cost on debt is 1% of normal loan, 5 million. Equity is it 4% or 2? 4%. 4% times 10 million. That's our equity financing. Don't go and include internal fund to it too. So these are the two things that make up our issue cost. 1% of 5,000 is what? 1% of 5,000 is what? Are you there?
50.
50. 50. 4% of 10,000. That's 200.
Yeah.
Right?
Correct.
200.
400.
Eh?
400, not 200.
400. So the total issue cost here is total is 450. That's our issue cost. Issue cost is not tax allowable, so I will not charge tax. I just move on. Because my issue cost is not tax allowable. Issue cost is not tax allowable. So I go to the next one, which is number 3, tax saved on interest. Number 3, tax saved on interest. Now, we have interest on normal loan. We have interest on subsidized loan. Interest on normal loan is at 8%. Look at it, because I gave us there. %. So the subsidized loan is 2% below this. So it means subsidized loan is 6%. So 8% times normal loan, 5 million. Subsidized loan, 6% times 4 million. So 8% of 5,000 is what? 8% of 5,000 is what? Hello?
400.
400, okay. Then 6% of 4,000 is what?
240.
240. So this is our total interest. Let me shift this one down so that I have more space. Total interest so my total interest is going to be 640. So I have 640 here. I now say tax. Tax at 30%. So 30% of 640 is what?
492.
492.
192. 192.
192. That's our tax saved on interest. Now go to the next one, number 4. Net savings. Net savings on subsidized. Net savings on subsidized loan. Net savings on subsidized loan. So my net savings, what is the amount of subsidy we receive? We receive 2% subsidy. We receive 2% subsidy times the amount of subsidized loan. Amount of subsidized loan is 4,000. 4,000. Then I will adjust it for tax. That's why it is called net. The net there is the tax we are removing. Net is the tax we are removing. 0.3. This will give us what? This will give us what?
$56. So this net saving on subsidized loan,
You said?
the 2%, that's supposed to be the difference in the rates.
That's the subsidy now. Instead of you to take loan at 8%, you took it at 6%. You get 2%
The
subsidy. Now.
difference, okay.
That's the 2% subsidy there.
Mhm.
So you say it's what? The figure is what?
56.
56. That's all. So the next thing is to go and do my summary for APV. Summary for APV. Base case NPV. Base case NPV, as computed earlier, is what?
1562.
1,562. Negative, Abby?
Yes.
$1,562 negative. PV of finance effect cash flows. PV of finance effect, cash flows. So let's get our PV. PV of issue cost. I've told you that you can use your risk-free rate, you can use your cost of debt. So let me use cost of debt. Our cost of debt is 8%. Our issue cost is what? Issue cost is 450. Issue cost is 450. So 450 times 1.000. That is 450. PV of tax saved on interest. Tax saved on interest. So you will compute annuity factor at 8%, year 1 to 10. You multiply by what? The tax save on incident interest of 192. So 192 times, let's compute it. Annuity factor 8%, year 1 to 10 will give us what? That will give us what?
671.
6.71.
6.710.
Oh yeah, multiply. What do we have?
1,288.
1,000.
288.
1,288. PV of net savings on subsidized loan. Let me shift all this here. That we have more space. Okay. PV of net savings on subsidized loan is going to be 56. 56 times 6.71. Yeah, what do we have? What do we have?
375.
Sorry, my laptop will go off. Let's 6 what?
675.8.
675.80. So add everything together. What do we have there? Add all this together. What will it give us?
213.8.
2113.8. Oh, this issue cost is negative, for sure, you know. It's outflow.
Oh, okay.
So we compute it. My laptop will soon go off. I want us to complete before it to go off, and I have to end the class. Okay, what we'll do is this. Let me transfer host to you, Mr. Ship, so that you can end the class when my laptop go off. I don't.
What about the recording?
Yeah, that's why I want to transfer the host to you so that you can end the class.
If I end it, what will happen to the recording?
It will come to me now. It will come to my page.
Okay.
Just ensure you Ensure you end the class, so please.
Okay.
So what do you have as the
Hey.
total?
The total is 1513.8.
1513.
0.8.
0.8.
Yeah.
So what is our adjusted percent value? Adjusted percent value. So what's the adjusted percent value?
Negative 48.2.
48.
0.2. Negative.
This is our adjusted percent value. If that adjusted percent value is not what is difficult to do, I'm telling you, honestly speaking, there's nothing special in adjusted percent value. Once you follow the format I gave you, there's absolutely nothing special. It's nothing special. Kí ló ṣẹlẹ̀, Mafus? Any question on this? Any question? Mrs. Angela? Question? Mrs. Question?
No question, sir.
Excuse me, sir.
Yes. I've excused you.
Okay. The
Hmm.
calculation of the finance effects, the
Yeah.
PV.
Hmm.
Okay. You said that you can use
You can use risk-free rate. You can use cost of
risk-free.
debt.
Okay.
Yes.
So
In
this one now
this case, I
you
use
use
cost of debt.
okay.
What I will do, look at it. You know, I'm done with my calculation now. What I will do is I put a note. The PV of finance effect cash flow has been computed using cost of debt as the discount rate. You understand? At the end of your solution, you tell the examiner this. That's all. That's the only thing you need to do. So that the examiner will be guided while marking your script. Do you understand?
Okay, sir.
So after solving a PV question, please ensure you conclude with this. Cost of debt, you wrote it back.
Cost of debt.
I wrote it back.
Okay.
I want to look at this night. So any other question?
For now, no question.
I send this thing now.
You know, the problem I will have is this. I was trying to, my network was very poor today, honestly. It's not that I forgot, I didn't forget. You know, we have 2 videos. This one will make it 3, Abby.
Yes.
I've downloaded them, but my network was not uploading them on the YouTube. I know I do upload before I send to you. So that's a challenge. But I will try it again this night, maybe midnight. I will try it again, whether it will go through. But you get it, definitely.
Okay.
Okay, sir. That is why we are not putting much.
What do you say?
I say I was waiting for the last.
Hey, yeah. Sorry about that, man. So sorry. You get it soon.
Okay, sir.
So sorry, we have to stop here because of my laptop. You can see. Very critical now. just 17%. So we meet on
Should I
Monday.
still end it from here? You can still end it.
Yes, I can send it. Have you transferred me? Have you transferred those to me?
Let me transfer. I'll go to your name, right?
You go to my name, you see more. Click on more. You now see transfer. Make a host.
Make host. Okay. I've done that.
You've done it, have you?
Mm.
Okay, thank you.
So I can leave, right?